Alright guys, today I'm going to show you how to sell a poor man's covered call. It's actually not that difficult. You're going to want to go to the search. You're going to search for the stock that you're trying to do a poor man's covered call on. We're going to do QQQ. You're going to go to trade options, and then you're going to want to go at least 6 months, but for this example, we are going to go out 2 years to my blind, January 2028. You're going to buy a very long, or 6 months, a leap call option. I'm going to go down to, I've got two at 545. That is at a 0.75 delta, which is a little bit riskier. Some people like to go to 0.80 because for every dollar it goes up, you're getting 80 cents. I did the 0.75 because this is a risk that I was okay with. And we're going to go and highlight that. And then we're going to sell a call option with that for a shorter term. I'm going to do a week. I currently have 2 of these. They cycle every 2 weeks. I want to get 4 so that they cycle every 4 weeks. There's math behind that of why I want that, but for now we'll show you the week. And then I did a 613 call option at a 0.36 delta. A little bit riskier than the 20, but I felt like it was a good bet, so I did a 0.36 delta, and we're going to click the 3.31. And as you can see, it's kind of got this weird, goofy little graph going on. All this is saying that is if it drops to 607, only going to get $1, but if it goes up to 613, I'm going to get $391. You hit continue, and then as you can see, it's $13,418. If I've got 2 of them, so it cost me about $26,000, and the max profit for this is about $1,644. So it would have to be at 613 at expiration for me to get that. Now let me show you the goofy thing about this is because it does say you're going to lose money if it goes too high up, and you're going to lose money if it goes to 0, which is true, you will. But the too high up isn't much of a problem. Look at this. We're going to go to simulate my returns. So if it's going to keep going up, like it's not really that big of a problem. It's only a week out, so it's nothing too crazy. And it would have to really go up there. It would have to go to $631 before it basically affects me. We're going to go all the way back. However, notice how we are already pretty much at the part where we're losing money here. That can easily be stopped with our short call option, the 613. If you look at this one's simulated return, on Friday, we're going to get $575. So this option right here is going to get exercised. It's going to be worthless, and we're going to get the $575. While we get to also keep, go back one more, we get to keep our 2-year call option at 545. So we have 2 years to sell premium, or sell calls to get premium, to cut down the price, and hopefully we actually get money at the end of 2 years because it went up so high we actually get money. But let me show you the math real quick. So let's say I paid $26,000 for those 2 options. We're now going to divide that by 24, which is 2 years. So every month I have to make $1,083. But I'm going to divide that again by 2. Or actually 4, because we're doing it every 2 weeks. So I'm trying to get profit every week. So I have to make $270 every week. We'll say $271. I have to make $271 every week to pay this back in 2 years. But as we already stated, on Friday, if this doesn't move, I made back $575. And then my second one, which is further down actually, my second call option right down here, 615, slightly higher. If nothing moves and this stays below next Friday, I'm getting $816. So as you can see, I'm making well above the $272 every week So I'm going to actually be profiting, and I should be able to pay this off within about 6 months.